Okay. Now let's try to understand about the turnover ratios. So basically turnover means the sales ratio. Everything is related to either sales or that is related to cost of goods sold, because this is totally related to sales. Now there is an important note for turnover ratio, that in the examples or in the, I can say, exam as well, we use the average balances. For example, if the question is about debtors turnover ratio, so we use average debtors. If question is about creditors turnover ratio, we use average creditors. If question is about inventory turnover ratio, we use the average inventory. However, many a times if the exam is asking you that you need to use the closing year end balances, closing balance instead of average balance, then you need to use that. And this may apply to all kinds of your exam. If this is a CPA exam, then it will apply that. If this is an ACA exam or any kind of exam, it may apply, because the question will at the end and ultimately tell you what needs to be applied. Now uh, we will understand these things a little bit in advance later, but let's see the first turnover ratio, which is accounts receivable turnover ratio. So basically what this ratio will say, this simply says that what is your sales, actually net sales, and what is your average accounts receivable. So we need to say our net sales and average accounts receivable. If we go above and go to our uh, P&L, so our average sales is $400 and our accounts receivable is how much? Our accounts receivable is 120 for the current year and 100 for the previous year. And if we take the average of both of them, the average will be 110 here. So let's go below and see what's happening. So we come here to accounts receivable turnover ratio. So our sales is 400 and our current year's accounts receivable is 120, previous year's accounts receivable is 100. I can say closing accounts receivable and opening accounts receivable, and we need to take the average of both of them. So let me put the average sign here. This was missed here. So if we put the average, you can simply say this is 400 divided by 110, which is giving the result of 3.6 times. So it means that in a year, basically we are getting money for 3.6 times in our business. So if I tell you that there are 360 days in a year and you are getting 3.6 time money from your debtors, so you will be saying on an average 100 days it takes to get the money from debtors. Why? Because we will see this 100 days calculation later on as well, but yeah, overall it's simply saying that you are getting 3.6 times money from your debtors in a year. Now why companies use this particular ratio? So simply they use it for the cash management as well. They see how quickly their sales turns into cash, how much time does it take to convert sales into cash. Similarly, they see the credit policy effectiveness as well. Let's suppose if the turnover is low, your sales is low, it means the customers are taking too long and company may need stricter credit terms. In our example here, there were taking 100 days. I will tell you later on how this 100 days is calculated, but 100 days debtors pay you. So 100 days is a long period of time and you need money quickly, so they need to evaluate the effectiveness of their credit policy. Similarly, if this turnover ratio is very high, it means the company is too strict and losing sales opportunities. So it may depend that how the credit policy they want to change. Similarly, they can see risk monitoring. If you have high receivable turnover, which means that you are having lower risk of bad debt. Here debtors are paying you in 100 days versus, let's suppose, some, in case of some companies, debtors are paying you within 30 days. So in this 100 days of case, there will be higher chances of bad debt, because people defer, the more they bad debt, they will be doing more. If they are doing lower payment days, so the lower bad debt will be there. Similarly, this is useful for investors and lenders for their assessment as well. Now let's further go and see some real world examples of these cases. So Amazon B2C model is a very high receivable turnover ratio because most sales are online and customer pay upfront. So here the turnover is very quickly. The immediately when the you purchase something, you become debtor for the Amazon, but immediately you pay. So there is a very high receivable turnover every time, every single day you are getting the money in case of Amazon. So Amazon is getting the money from you. So there is a very high turnover ratio. That's why Amazon has little risk of stuck receivables. They are not having any risk of debtors because they are getting money very quickly. Let's see the example of AT&T company. Now they are having lower receivables turnover because it bills millions of customers monthly and collects payments over time. So AT&T is billing people monthly and they are getting payments monthly as well. So their turnover is here again very less. When I say turnover, don't you think, you should not be thinking about this, their sales is less. When I say turnover means turnover ratio, their turnover ratio or is less, which is like good thing, because the less the more days it takes for someone to pay you, the lesser turnover ratio will be there, just like we have seen in above example. And if we see the next example, just like Caterpillar Incorporation, which is in heavy equipments. Now this Caterpillar sells large machinery often on credit. So the company is selling the things on credit. Now receivable turnover is lower because customer pay in installments. The customers again pay very quickly on installment basis. That's why receivable management is critical in heavy manufacturing industries. Now Walmart is having a very high receivable turnover, close to immediate, because most sales are cash or credit basis. So Walmart is selling immediately and they are getting cash immediately. So there is a high credit or receivables turnover ratio. So basically this turnover ratio simply comes to one thing, that if the turnover is higher turnover ratio, what will it do? It will simply have your uh, lower collection days, and lower collection days and lower collection days will be your better for business. The more higher turnover, meaning quickly your debtors are converted to cash. And if the turnover ratios are low, meaning very slowly they are getting converted to cash. Okay, so I believe this you understood. Okay.